Ladies and gentlemen, Greg Michalowski from ForexLive.com. Today's date is September 25th, 2023. This is a Forex quick look. I'm going to take a look at the Aussie versus US dollar. Looking at the price action over the last 6 trading weeks, there's been a lot of ups and downs and ups and downs. We moved initially to the downside here and then back higher and then back lower and then back higher and then back lower and back higher and back lower, and we started to narrow the trading range in trading last week and trading above and below the green and blue lines on this chart. This green line represents the 200 bar moving average on the 4-hour chart. It comes in at 0.6440, and the blue bar represents the 100 bar moving average on the 4-hour chart. And trading at the end of last week, the price closed at 0.6438, just below the green bar but above the blue bar. So it was in a neutral territory, territory for this currency pair. Buyers and sellers were still battling it out in between those two levels, but the price in trading here today started to rotate to the downside and get below the 100 bar moving average, tilting the bias more to the downside. It would take a move back above the 200 bar moving average to increase the bullish bias, but as you can see, the high price, although it did move back above the 100 bar moving average, couldn't get it back above the 200 bar moving average, and we're currently back below that 100 bar moving average at 0.6426, currently trading at 0.6420. So the sellers are trying to make a play here. They're taking their shot, but that is no different than these other times when the price traded above and below either the 200 bar moving average up here, below the 100 bar moving average here. So there is a history of these breaks failing, but you never know when this is going to be the real one. Okay, so for trading here today, what traders want to see is for the price to stay below the 100 bar moving average or below the 200 bar moving average. Those are risk levels for traders, depending upon your risk bias and the risk tolerance. So if you only want to risk a few pips, 6 or 7 pips or 8 pips, stay below the 100 bar moving average and hope the price moves lower. If you're more risk tolerant, then use the 0.6440 level as a bias risk defining level. As long as the price remains below that level, you can hope for further downside momentum to the downside. Where do we go? Well, these levels right through here become next key targets. There's sort of random areas where there was perhaps a number of different swing lows through here, then the swing highs through here and here, and then swing lows through here and here. But you can see it gets pretty, there are times when the price moves below those areas. This area down here, this yellow area right here, is another target on the downside where we might expect some slowing of a move to the downside, only because it has done so in the past. And the last time the price tested the lows was in trading last week. Came in that area right here, and then the previous week was also in that area right there. So this area between the 0.6379 and 0.6387 is going to be another key target on the downside, that if it gets down and gets through, it would increase the bearish bias looking toward the extremes, of course, and getting out ultimately outside of this red box. So sellers are making a play in the Aussie versus US dollar below the moving averages here. If they can stay below those levels, the bias remains to the downside for this currency pair. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.